Markets get their hopes up. Investors look past fears of a Cold War with China and a possible second wave of COVID. This is Bloomberg Wall Street Week. I'm David Westin. This week, Governor Phil Murphy of New Jersey.
This is one of these moments where the federal government plays that existential role that no one else can play.
Contributors Stephanie Flanders.
If it is designed to help countries respond to this pandemic, I think there's a sense in which it has to happen on a reasonably tight schedule.
And Larry Summers.
Lockdown is actually less the issue than people's fear.
BlackRock's Rieder.
The Fed actually hasn't done a lot in the credit markets at all. But what's happening is there's a sense that the Fed will be there for emergency reasons.
NASA Administrator Jim Bridenstine.
NASA has a long history of doing stunning things in the middle of very difficult times.
And Saira Malik of Nuveen.
Having this very quick coronavirus hit the markets has caused this level of volatility that's almost unprecedented.
It was a week of hope, but is it hope triumphing over experience? Equities continue to climb higher, but lurking in the background are those growing tensions between Beijing and Washington, and as well, a fear that there might be a second wave of a pandemic that, as of this week, has claimed 100,000 American lives. The economic numbers are stunning. To be sure, this week, jobless claims fell for the first time in 2.5 months. But during that period of time, over 40 million Americans have become unemployed.
The jobless pull down will be much slower than the economic recovery. That's always a phenomenon that happens.
In Europe, there's talk that GDP could fall as much as 12% this year.
You're really talking about an economy in the euro area that is, in one given year, going to shrink more so than it has, for instance, during the the great financial crisis.
Fiscal and monetary authorities continue to look for more solutions. That's after they've already thrown trillions of dollars into the stew of government support. So which story is it we should believe? The hopeful one of the equity markets back almost to the level they were pre-COVID, or the one that tells us that we are not yet out of the woods? And to help us sort through those stories, particularly on the equity side, we welcome now Saira Malik. She is head of global equities for Nuveen. Welcome, Saira. Give us a hint here. We heard the markets, we saw the markets equities push up through the week, and they were concerned about China. And then at the very end of the week, President Trump gave a news conference and said, we're really going to go after China with a lot of sanctions. And what did the equity markets do? Well, apart from the Dow, they actually went up.
Well, this is a very unloved equity market rally. Investors were holding their breath all week, waiting to see what would happen between the U.S. and China. And really, it wasn't anything that was unexpected. We did not see any increased sanctions that were material. The phase one trade deal is still in place, and investors blew that off and kept moving. And that's kind of been the case. There's a lot of good and bad data for investors to try to analyze right now. On the good side, we have hope on vaccines. We have regional reopenings that are leading to upticks in economic data. But on the downside, we have to worry about a second wave. And also the consumers who led the last bull market led us into the shutdowns and also will be the one who leads us out. And we're not seeing a significant pickup in consumer spending. Actually, we're seeing saving rates increase. So, and then you look at the markets and they've priced in a lot of that good news. So now I think investors are going to become increasingly worried if U.S. China tensions actually accelerate from here, or we start to see other bad signs. I think it will be time for the market to roll over in that case.
Well, that's interesting because we've had 2 months in a row now. We're at the end of May. We've had 2 months in a row now, the S&P being up rather substantially. And yet people keep saying, well, the economic numbers don't really justify it. At what point should we begin to believe the equity markets rather than the economic numbers?
Well, if you look at what's working in the equity markets for 80% of the time this year, it's actually been growth stocks, which really is a sign of quality working. So the markets aren't necessarily believing the economic numbers either. If we started to see a real sustainable pickup in cyclical companies, which are very cheap, we did see this for a few days this week, then I think you'd start to believe that people are looking for economic strength. In order to see that, we'd want to see maybe really positive signs on a vaccine. If we get a vaccine in place sooner than expected, maybe we'd see even stronger than expected economic data. But our view is that over the long run, it will still be a quality growth kind of environment where those companies which are less levered to the economy will continue to outperform like we've seen basically for over a decade now.
So it wasn't just cyclicals this week, it was also small caps and to some extent EM, emerging markets that came back. Does that tell us anything about this rally, or do you think this was just a fill-up, just a one-off this week?
Well, another thing we've seen that's a positive for non-U.S. markets is a weaker dollar. So that's another support for non-U.S. markets. We actually are positive on emerging markets. They've been laggards over the last bull market cycle. They were underperformers going into the COVID-19 environment that we saw. And one area that really got hit hard was Latin America, one of the worst performing emerging markets. And we actually think that, somewhere like Brazil, which is behind the curve with COVID-19 and struggling with geopolitical issues, they could hit an inflection point with some global economic growth, and that reform story that was in place before we had all of this turmoil could come back in. And that could be kind of a very out of consensus place to look for strong companies that are surviving the crisis over there.
So was your basic take, Saira, that we're still in the world of, I think they're called stay-at-home stocks, a lot of those tech stocks, which we're all using with all of our electronic paraphernalia at home, that really is the place to be if you're an investor? It's too soon to go back into some of the things that were really beaten down badly by the pandemic.
Well, we're looking more for barbell portfolios. The interesting thing about these technology companies is the stay at home in this environment actually accelerated trends that were already in place. So trends to digital, online, working from home, all of that was already in place. It's even stronger for these companies now. And trends on the negative side, such as brick and mortar retail, actually have gotten worse. There's other trends that I think are going to kick in because of this environment. One is going to be shorter supply chains, more localization rather than globalization, higher inventory levels, higher food safety levels. Even autos could become interesting on the cyclical side as people may choose to shun public transportation and go away from more of a sharing economy and more towards having their own cars again. So there's a lot of trends in terms of quality that you can play, not only from growth, but also to value. Another interesting area was actually ESG. Companies with strong ESG practices, environmental, social governance, actually tended to outperform in this environment because they tend to be more heavily indexed to quality.
At the same time, is there something of a divergence within the tech sector between, on the one hand, sort of, I can say, at the infrastructure tech as opposed to the consumer-facing tech? We know that President Trump has really gone after Twitter and the social media more generally this week. Do you see two different sorts of characteristics of tech right now?
There are definitely going to be tech winners and losers. We've seen a lot of technology companies hitting new highs. Social media, I think, has that regulatory dark cloud on it now. Premium valuations, that's not an area we'd be looking to until we get more clarity on whether laws would actually be changed when it comes to how they're regulated. Tech companies that benefit from the cloud, from working at home, from online practices, we think those will only get stronger. But then some tech companies that were benefiting from more of a sharing environment, those may be now structurally impaired for the time being. So you definitely need to be selective within technology. And also, if you look to value, which again, very cheap, which could have a comeback, you want to again stick with quality value. Companies with strong free cash flow, strong balance sheets that are going to be survivors in any kind of volatile economic environment, because the economy is still unclear right now in terms of could there be a second wave and how fast will we really reopen and come back to business.
Saira, how do you sort out what's real, if I can call it that, as opposed to what is the central bank? We had Fed Chair Jay Powell again this week saying he's willing to do whatever needs to be done. How much of the valuation in the market right now is really just central bank liquidity?
I think that has been a real support system for this environment. If you look, we've had almost 450 global stimulus measures in the last year, from rate cuts, quantitative easing, and just flat out stimulus. And that's a very strong message for the market that this will continue. If we see a second wave, if the economy remains very rocky, we do have the support from global central banks. I think that's a very positive for the market, and to help provide that support and that faster than expected comeback that I think most investors were not expecting to see.
Finally, briefly, Saira, if you want to hedge against the possibility of something of an uptick, a second wave, what do you go to?
I think then you're looking very much into quality growth, such as healthcare companies. These are going to be other beneficiaries. If you're worried about a second wave, healthcare companies, not only the ones producing vaccines, but people are going to be more focused on wellness. There could be food safety companies. I think you really would want to look for those higher yielding companies, income companies that are paying good dividends that you can rely on. You would want to go into safety. But I think all of these companies, because of the trends in place, they will continue to do well, not only if the environment gets worse, but even if it gets better, because we expect rates to remain low. So yields will be important, and also healthcare. This is now a long-term positive for these sectors.
Okay, Saira, that was really terrific. Thank you so much. That's Saira Malik. She is the head of global equities for Nuveen, and she's telling us you should pursue still a barbell strategy of both the real growth possibilities as well as some of the more speculative ones. That is Saira Malik, as I say, of Nuveen. Thank you so much for joining us today. Coming up, Rick Rieder of BlackRock on what the markets are telling us and how much it might be distorted by central bank action.
What's happened when you drop rates to so low, it's causing people to say, gosh, where do I go to actually be a lender?
This is Wall Street Week on Bloomberg.
I think the Federal Reserve has got to move quickly, and I think they will over the next several weeks. I think they will lower short-term interest rates, and that interest rates in general on high-quality bonds, not on low-quality bonds or junk bonds, but interest rates on high-quality Treasury bonds will drop precipitously. I think it's quite possible that if the economy remains in a recession, which I think it is, that we could see long-term Treasury rates close to 7% within 12 months.
That was Wall Street Week back in 1990, and what a difference a generation makes. Now, instead of talking about yields on treasuries approaching 7%, we're talking about the real possibility the Fed just might contemplate negative rates. Rick Rieder of BlackRock knows rates in this new world, and he sees the effect of Fed action on yields right across the curve.
What the Fed has done has been pretty powerful, but you know, there is something that I think people underestimate when you think about what the Fed does, what central banks can do. When they wheel out the bazooka and say, this is what we will do if we need to, the markets tend to take them at their word, particularly the Fed that has a lot of credibility today. So the Fed actually hasn't done a lot in the credit markets at all. But what's happening is there's a sense that the Fed will be there for emergency reasons or to provide for markets to actually function effectively. So what's happening now is you're seeing a manifestation of what the Fed has done is take interest rates to zero. They're going to keep them at zero for an extended period of time. And as long as the economy is reasonably stable, then this demand for income, and I know we've talked about it a bunch of times, the demand for income in the world because of the aging demographic, et cetera, is so profound. And as long as people feel like, gosh, I need to, the economy's going to be stable, I can start to go and get that income. And then when you think about the size of the high yield market, David, it's only $1 trillion market. If you think about the market cap of Amazon, it's more. It's been, and you think about Amazon's bigger than the entire high yield market. There's not enough income in the world, and so what you're seeing is this. Gosh, I got to get income. Economy's doing better. I'm anticipating it will continue to do better, and so the surge of money that's come in has been impressive to say the least.
So as a result, yields are really suppressed, I would say, and it's reasonably cheap still to borrow money despite everything that's happened. Does that sort of give governments a blank check for stimulus? We had two former central bankers, Carstens and Weber, come out and say this is really dangerous because we're basically going to have the central banks funding the government debt.
So, you know, that's a long, complicated discussion, but I would say a couple of things that are really important. One is there is something that's really profound about the ability for the governments to actually borrow today. I'm not saying there's an unlimited amount the governments can borrow. They have to be conscious of you can put too much debt on a system, you create a crowding out effect for the corporate sector, households, financials, et cetera. But today, because of the demographic we talked about, the system is actually set up to be a lender. Insurance companies, pension funds actually need the assets and actually need to lend. And what's happened when you drop rates to so low, it's causing people to say, gosh, where do I go to actually be a lender? And so in today's environment, you can actually create some more debt on the system as long as you're creating nominal GDP, which I would argue in the U.S. we will have some improvement, significant improvement in nominal GDP to pay down the debt over time. But I think it's fair to say we shouldn't go too far, but to put a bit more debt on the system, given the circumstances, is actually not as scary as it's been historically. Think about it. When we were back in 06, 07, the households were indebted because of the housing market, the financials were indebted. We're in a better position today. That being said, you've always got to be pragmatic about it. You can't just keep doing it. But we can afford to do a little more debt, certainly to get to the other side of what is a shock to the economic system.
So Rick, that's the fixed income side of your book. Let's go over to the equity side, because a lot of people are saying, boy, the equities look like they're pretty high considering what we're really seeing in the economy. Are the equities telling us something meaningful about the recovery?
Well, the first is we can't leave the fixed income side because it's part of why the equities are doing what they're doing. When you move interest rates to zero, then you're basically telling people you would need to find something else to do. And when you can't create income in other ways, you need to find something else to do. And you create this transmission effect that gets into the discount rate on equities. It gets into the alternative assets that equities are. And listen, I think the equity market is too high on a short-term basis, given what the economy is telling you. But part of what I think people have been maybe a bit short-sighted about is you don't buy equities for the next quarter. And people talk a lot about next quarter and PE ratio off of this year. If you go over the intermediate term and think about, gosh, we're going to have low interest rates for a long time, and you think about where earnings are going to be over a long period of time, because equities are a long duration, the longest duration asset there is. Equity valuations, when you take equity risk premium and think about where we are versus on a low interest rate, on a low level where companies can borrow and actually buy back their stock if they want to, equities are not high. I mean, I think they can go higher. I mean, near term, do I think they should pull back a little bit? Probably. But, if you're building balance in your portfolio and you're a long-term investor or medium-term investor, to hold equities in the portfolio, versus owning, you're not going to make any money owning the 10-year Treasury note at 68 basis points, 69 basis points. So I do think that equities make sense as long as you're an investor and can be thoughtful about, gosh, I'm not going to look at, could I go down in the next week or so? You could go down a bit, but I think people are underestimating equities for the intermediate to long haul are actually still okay value here.
That was Rick Rieder of BlackRock. Coming up, taking our minds off the pandemic here on Earth, as the United States tries to send astronauts into the heavens for the first time since the days of the shuttle, and to do it as a commercial enterprise.
What NASA is trying to do right now, we are trying to create a robust commercial marketplace in low Earth orbit.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. NASA's plan to launch astronauts from U.S. soil into space for the first time in nearly 10 years was postponed this week because of weather, but it is rescheduled for the weekend. I talked with NASA Administrator Jim Bridenstine about this new public-private partnership and how it works.
We're largely focused on the International Space Station, but we are also the customer for this launch. So as the mission management team goes through the countdown sequence, we're going to have NASA engineers and NASA flight directors that are going to be side by side with the SpaceX engineers and flight directors. And if at any point we feel uncomfortable with the direction that they're going, of course we can halt the launch. But what NASA is trying to do right now, we are trying to create a robust commercial marketplace in low Earth orbit. That's the goal, which means we need SpaceX to go get customers that are not NASA. We want to be a customer, but we want to be one of many customers. So what we're doing is we're giving SpaceX a lot of leash. In fact, we have contracted for them to actually do the launch almost independently. But make no mistake, our engineers and our technicians have been involved in the development of this capability, and our astronauts have been involved in it. So again, we want to be one customer of many. We are helping to grow this commercial marketplace by being a tenant customer initially, but we also want to have numerous providers that are competing against each other on cost and innovation and safety. And when we achieve that, it's going to transform how we do spaceflight. It's going to bring down costs and it's going to increase access.
So you talked about commercialization, which is particularly interesting to our audience, how that works. When it comes to SpaceX launching satellites, it's pretty clear. A bunch of companies as well as governments need satellites up in orbit. What about for astronauts? Is there the same demand, commercial demand? What's the top line, the revenue there?
Yeah, at this point, the history has been that government creates the demand and then government creates the supply. And so what we're doing here is we're trying to change that paradigm. Certainly, we are creating the demand, and we're turning to commercial industry to give us the supply. But again, what we want to see eventually is the demand would come from others as well. And so what are we doing right now? We're using the International Space Station to do things like we're creating human organs in 3D, printing human organs in 3D using adult stem cells. Right now, it's just tissue, but eventually it's going to be full organs. And we can only do that in the microgravity of space. If you try to do it on Earth, the tissue just goes flat.
Whenever we talk about commerce, we talk about competition, because that drives commerce to a large degree. Talk about two kinds of competition. One is Boeing against SpaceX, because you've got two horses in the race, but one seems to be lagging behind. Do you need Boeing to catch up? And what about Soyuz? Are you still going to be doing business with Soyuz?
So the Boeing and SpaceX paradigm, I'll talk about that first. So remember, SpaceX was doing commercial resupply of the International Space Station, and they were largely doing it with a lot of the same equipment that they're now going to be doing commercial crew with. Boeing did not participate in commercial resupply. So Boeing went straight from nothing to commercial crew. So that's a lot harder of a starting position. And so yes, they are a little bit behind right now. And of course, it cost us a little more to get them ramped up because of their starting position. That being said, we are committed to having two partners in this future that we envision. But we also believe this is important. There are other companies right now that are stepping up to the plate that want to be part of this. Sierra Nevada Corporation, Blue Origin, which is Jeff Bezos's organization. So there's other partners out there on the horizon for this commercial marketplace eventuality.
And what about Soyuz? Are you still going to work with Soyuz? You've spent $3.5 billion with them over the last 10 years.
That's right. So when we think about the International Space Station, half of it is the United States segment with all of our international partners, and the other half of it is the Russian segment. So if we want to make sure that we keep it crewed with both Americans and Russians, then it will be appropriate for us for Americans to launch on Soyuz rockets and for Russians to launch on commercial crew rockets. Now, that being said, the difference is instead of us going out and buying seats at $90 million a piece, now we're going to be able to do a no exchange of funds trade, which is a very different, it makes it more of a partnership and less of a dependency. So we like the partnership. We want to get ourselves off of the dependency.
This is in the middle of a pandemic. How important is it for the United States right now to be returning astronauts to space from United States soil when we are fighting this COVID-19?
That's so important. Look, NASA has a long history of doing stunning things in the middle of very difficult times. We go back to the Apollo era. We saw, a war raging in Vietnam and protests in the streets and at the Capitol and at universities. We had civil rights abuses and civil rights protests, and of course, we were in the height of the Cold War. And in the midst of all of that, we were able to send Neil Armstrong and Buzz Aldrin to the surface of the moon. And for that unique moment in time, everybody in the country united. And we all looked up and we dreamed bigger dreams. And because of that moment, there are so many people at NASA that are doing even more amazing work today. We need to create those stunning achievements to inspire the next generation. Yes, we're in the midst of the coronavirus pandemic. NASA has been very aggressive in having people work from home. We did that intentionally because we wanted to protect this mission. There is nothing more important for us right now than launching American astronauts on American rockets from American soil, something that we have not done since 2011, the retirement of the space shuttles.
That was Jim Bridenstine, NASA Administrator. Coming up, Europe finally gets its act together for a fiscal stimulus package. We talk with Bloomberg's Stephanie Flanders about whether it is too little and too late.
You don't necessarily think that the fiscal support is going to be as effective or as quick as support from central banks.
This is Wall Street Week on Bloomberg.
Central banks are taking stock of the economic toll of the coronavirus outbreak, and it might be worse than expected.
The sort of medium scenario, which was around 8% negative, and the severe scenario, which was a little bit north of minus 12%. It's very likely that we will be somewhere in between.
Like its counterparts, the ECB is propping up the economy by stepping into the credit market. It launched a 750 billion euro emergency asset purchase program in March and is expected to expand its program next month.
We have flexibility, and we have flexibility in the short term, not only in terms of the assets we purchase, we buy, but as well in terms of the timing of the purchases.
A new proposal of fiscal stimulus from the European Commission, combined with asset purchases, is inviting a flurry of new bond sales.
Whether we call it Eurobonds, Corona bonds, recovery bonds, but it doesn't change the underlying structure.
Annual debt issuance in Europe has surpassed 900 billion euros this year, sparking concern from former central bankers. Agustin Carstens, Mexico's former central bank chief, said, "Bottom line is that there is a need to recognize there's limits of monetary policy. Central banks cannot intervene in government debt markets on a large scale." Central banks' debt buying programs can have long-term consequences.
The issue at stake is that can help address a liquidity crisis, a credit crisis. What it cannot do is address a solvency crisis where you have a bunch of companies and consumers who simply have too much debt to ever repay out of their revenues, which are now collapsing.
Europe finally stepped up to the plate this week on fiscal stimulus, or at least the European Commission did, with a proposal for a 750 billion euro package of loans and grants. Now all it needs is approval of all of the member states. Wall Street Week contributor and Bloomberg senior executive editor for economics, Stephanie Flanders, says that this is a big deal.
This is really a historic move, potentially, by the European Commission. And as you know, David, it sort of comes after we had the leadership of the two most important countries in the European Union, France and Germany, President Macron and Chancellor Merkel coming together and proposing a very similar plan last week. So we know that something like this has the support of those key players, which makes you think it is quite likely to happen. But the real importance is this is serious budgetary support, a big chunk of it in grant form. So it's real money. It's not loans with a lot of strings attached, which is designed specifically for the case of this crisis to help the countries that need budgetary support. So this is going to be countries like Italy and Spain that most need help, in effect getting money from the richer economies, which, as you know, throughout the Eurozone crisis, that was the line that the Germans really didn't want to cross.
Well, a terribly important point. It goes to where it's needed, but it takes it away from countries that are doing better. We always think about Germany in that connection, but we also have things like the Netherlands. We have Austria and things. There's a few steps they have to go through before this plan actually becomes real, right?
Yeah, it will need to get the support of everyone. And of course, when it comes to Europe with 27 countries, that's not always going to be easy. But I think what is different this time and why we think that something similar to this will ultimately happen is what I said earlier, is the fact that you have France and Germany on the same side pushing for this. In the past, of course, it's been Germany that's been, if you like, the ringleader of the frugal group of countries that feel like they've managed their affairs very well and they don't want to reward countries who've got themselves into difficult situations like Italy. And that was very much the dynamic in the Eurozone crisis in 2012. There was not a desire to have a lot of burden sharing with those countries. But COVID, in so many ways, is different, and it is Germany is looking at it differently. Not only is it opening the spigots in terms of its own spending that we haven't seen in the past, willingness to borrow a lot of money, but also is understanding that this is not. You can't blame this on Italy not having structural reforms, of being an inflexible economy. It is. All these countries have been faced with a shock which is not of their own making.
Germany is looking at it differently. At the same time, Chancellor Angela Merkel made it clear that it's going to take some negotiation, some time to get this done. So, Stephanie, that sounds like we shouldn't be waiting for this anytime soon. Are we talking about the fall or even toward the end of the year?
Yeah, I mean, of course, nothing is ever instant. And, of course, that is why we have often said that this kind of government support, even when it's coming from national governments, you don't necessarily think that the fiscal support is going to be as effective or as quick as support from central banks. So, of course, what the European Central Bank continues to do is going to be very important for Europe. But I think because this is specific, this is supposed to be a one-off. So, of course, there's a possibility that we'll never see this again, although it's symbolically important. But if it is designed to help countries respond to this pandemic, I think there's a sense in which it has to happen on a reasonably tight schedule. And if it did happen for January 1st of 2021, I think it could still give serious support to countries that will be facing these enormous bills from the pandemic.
That was Bloomberg's Stephanie Flanders. Coming up, we talk with the governor of one of the states hit hardest by the coronavirus as it moves cautiously to open back up. Governor Phil Murphy of New Jersey.
This is Moneyball. This is what's the data telling us and what's that data allow us to do.
This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. New Jersey has been one of the states hardest hit by the coronavirus. And from the very beginning, its governor, Phil Murphy, has been there, organizing the efforts to flatten that curve, comforting the afflicted, and as he puts it, playing Moneyball by sticking to the science.
I hope what we can offer folks is that, some basic sort of themes, which is number one, public health creates economic health. In as much as we're all chomping at the bit to get everything opened again, if we transpose those steps or we jump the gun, I think we throw gasoline on the fire. And I think we've been very deliberate. And the second-handed glove with that is we say all the time that data determines dates. So in as much as we don't ever want this to be abstract, in fact, we eulogize a handful of people every day. I call families every day to make sure it always stays personal. Having said that, this is Moneyball. This is what's the data telling us and what's that data allow us to do. And I hope that we get that right. So far, so good.
At what point do you expect this is going to bottom out? Do you see a bottom to this unemployment and it's starting to turn back around?
Please God, sooner than later. I think it's correlated with a couple of things, David. Number one, the continued responsible reopening, that we get that right, that we don't have, we're going down a one-way street. I don't want to turn the car around and go back the other way. And secondly, I'll give you a big game changer, and that is direct federal cash assistance to states and municipalities. It's talked about. There are a couple of bills, including Bob Menendez, one of our great senators, co-sponsor with a Republican colleague, Bill Cassidy in Louisiana, is a good example. Speaker Pelosi with the HEROES Act. We need that, not just a blue state, not just New Jersey. All American states need that. And frankly, that's the biggest potential accelerant that's available to us right now to reboot our economy and get as close to that long sought after V-shaped recovery. That's, to me, the biggest game changer available.
So give us a sense of those numbers, if you would. How much of that is just filling a hole, and how big is that hole because you lost a lot of revenue and had increased costs, and how much is really you need to reinvest in order to get things going?
Yeah, this is all about, let me give you a couple of numbers. We announced the budget at the end of last week for the next 4 months. So we extended our fiscal year to September 30. So we're talking about 4 months and a few days. We had to cut or defer well over $5 billion of expenses. Or put it differently, we said the revenue loss, as best we could tell, from June of 2020 until June 30th of 2021, $10 billion. This is the difference between, but there's a certain myth out there, well, we're just going to help you all because you hadn't managed your legacy realities, your outstanding indebtedness or your structural deficits or your pension obligations. We were doing just fine with that. It's a long slog, but we were making a lot of progress. This is about keeping firefighters, police, EMS, healthcare workers, educators employed. Literally, the consequence, or the alternative, I should say, to not getting that funding is a whole lot of layoffs. We think as much as 200,000 more at the state level alone in New Jersey.
Are there ways to make up some of the revenue shortfall in other ways? I know you've increased tolls, but I think that was specifically to do some road work. But are there tolls or license fees, taxes that you could get some more revenue?
Perhaps, David, but I do mean this. The whole is so significant from this, and it's not just New Jersey. This is one of these moments where the federal government plays that existential role that no one else can play, and we need that role to be played right now to its maximum.
What about some infrastructure spend? We've heard your brother, Andrew Cuomo, across the way in New York saying, let's advance some of the infrastructure spend.
I love that. The Gateway Tunnel is something that Governor Cuomo and I have been pounding away on. We think it's a game changer. It's a huge, this is building new tunnels under the Hudson River. The current ones were built in 1910. It's a new bridge on our side. It's reimagining Penn Station on the New York side. That's a great example. Good news is the Trump administration just forwarded $90-odd million on the New Jersey side of that. But infrastructure absolutely is a potential game changer. It employs a lot of folks. We're a proud union state. That's a good thing. We'll take that in absolutely as soon as possible.
Finally, give us a sense out over the horizon. What sort of changes do you anticipate because of this pandemic for New Jersey? And I'll give you an example. Do you think that people, after this is over, whatever that means, will continue to commute in daily into Manhattan, or may that change some of those patterns?
Yeah, that's a great question. And I don't know that any of us know the answer to that, but my guess is that we've been changed permanently. From the little but important stuff like social distancing and wearing face coverings to the bigger things. We got about 25 or 30% of our workforce that commutes to where they're going and could, if they choose to, stay at home. And most of them have done just that.
That was Governor Phil Murphy of New Jersey. Coming up, our special contributor Larry Summers is here to wrap up the week. This is Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Westin. We wrap up the week with our very special contributor, Larry Summers, as always. So, Larry, welcome. Good to have you here. Throughout the entire week, markets were sort of a little nervous about China. And then at the very end of the week, President Trump had a big news conference at the White House. And he said, boy, there are bad things coming for China. He did withdraw from the WHO, so there's going to be sanctions. But the markets kind of shrugged it off. Is this real or is it saber rattling?
Some of both. Our withdrawal from the WHO is probably not as consequential as when the United States decided not to join the League of Nations after the First World War, but it may be the most important withdrawal from internationalism that the United States has engaged in since the Second World War. It's a completely irresponsible act that will set back the effort to combat disease in the world and will ultimately hurt our security. God knows the WHO is deeply flawed, but the United States should be fixing it, not abandoning it. And future generations will regret this decision and the lack of trust that comes from it. It's not something that affects the profits of companies over the next several years, so it doesn't affect the stock market. But that's the really consequential thing that happened today. The sparring on Hong Kong doesn't involve something that is going to concretely hurt corporate profits. That's why the market didn't react. And the market's been pricing in the fact that the United States and China are at deep loggerheads in a way they haven't been since Nixon opened to China 50 years ago, and that's what's continuing to play out and played out today. But I think that the fact that there's no market response shouldn't make people complacent, not about the United States abandoning the World Health Organization and not about the state of the U.S. China relationship, which I believe if history goes wrong, goes off track, in this decade, the far and away the most likely way in which that will happen is fissures between the United States and China.
So Larry, if the goal is to modify China's behavior in some way, shape, or form, Is there a way to do that as a practical matter? It looks like President Xi's decided what he wants to do, whether it's in Hong Kong and other places. It doesn't look like anything we're doing is changing his mind any.
Look, I think one of the lessons of human life, and it's also a lesson of global life, is that it's harder to change people and it's harder to change nations than we often hope it would be. And that threats and scolding are not all that effective as tactics. And so I'm not surprised that this isn't working very well with respect to China. And of course, it creates all the wrong incentives over the medium and long term. It strengthens the people who say in China that any kind of interrelationship with the United States is a mistake, against those who want to be more intertwined with the United States. It teaches China that they need to avoid any kind of vulnerability to us, which means they will put more emphasis on splintering their technologies and their economic approach from anything that's global and is involved with us. But in fairness, these are really hard problems, and it's much easier to object to particular means that are being pursued than it is to propose ways that will be effective. I think over time, we're going to have to reduce our aspirations for how much we're going to change China and concentrate on the set of issues that most directly impact on our security. And we're going to have to think about aspects of our own behavior that at times are provocative, and recognize that in a bargain, you have to demand, you get to demand things, but you also have to respond to the other side's concerns, and that our concept can't be that we run the world and China gets to decide how exactly it wants to fit into the world we run. That's probably not going to work given China's current strength and broad economic power. The one other thing
Larry,
I would
you've
say,
consistently
I'd say one other thing, if I could, David. I think probably the single most serious foreign policy error that the Trump administration has made is the more you think that China is in various ways a serious threat, the more important it is that we have strong global alliances with all the other countries in the world. And so what is odd is a strategy of elevating the China threat and at the same time not aggressively trying to get close to all the other countries, and instead in many ways abrogating commitments to them and lashing out at them in various ways. In a world where we want to put trade sanctions on China, what could be dumber than threatening trade sanctions on Canada and Europe and all the other countries who we need to cooperate with us if we're to have a realistic chance of influencing China's behavior?
Larry, I want to come back to the United States just for a couple of minutes here, because you've expressed concern about how quickly we're coming back, at least in some parts of the country, whether we're ready, whether we have the testing, the contact tracing, things like that. We are starting to open back up. Even here in New York now, we're hearing New York City may be opening within the next couple of weeks. How will it be different, these cities now, these big cities? There's a lot of talk now about whether these cities like New York City, like Boston, other places, whether they'll ever be the same again.
Look, I think they're two separate questions there, David. Several weeks ago, a set of criteria were laid out. There seemed to be a consensus around those criteria. In fact, the Trump administration laid them out for how much progress we had to make with respect to health, how much death counts had to come down, how much testing had to be in place. None of those criteria have been met, and we're still moving ahead. And I think those were probably reasonable criteria when we laid them out, and I think it's therefore quite risky to be moving ahead. I can understand why the decision is being made, but I'm very concerned, and I think we are taking substantial risks of a second wave of a reemergence. Everything the world knows about pandemic disease suggests that it doesn't grow. It's not an inverted V. It doesn't grow and then revert back to zero. It's more like upside down W. It goes up and then it comes down and then it goes up again. And I think we're taking a substantial risk of that. And people, markets need to be aware that that's very much a risk we're taking. We could be doing much more to minimize that risk. We could have a much more organized national effort to massively increase the level of testing in the United States, for example, but we don't. We could be engaged in a major effort when there are tens of millions of people who are unemployed to hire people to do contact tracing so as to reduce the spread. We could recognize, as is increasingly being recognized by the scientists, the problem of super spreaders, and be trying to pursue targeted strategies directed at making sure that any super spreaders are separated from the rest of the population as rapidly as possible. But we're not doing any of that. And so I think we are taking substantial, needless risks of more trouble down the road. We may luck out. It may be okay. Nobody can predict pandemics, but sometimes people don't buy insurance and they don't get sick. And it works out okay not to have bought insurance, but that doesn't make it the right thing to do. So I'm alarmed at our strategy. I think it's extremely odd that as a country we are debating, and this is a bipartisan issue, we are debating a $3 trillion bill, and not 2% of it is devoted to finding vaccines and therapies and increasing testing. And so I would suggest as a minimum threshold of responsibility that 2% of any legislation we devote to addressing these economic problems be devoted to the health aspect.
Okay, there you have it. Thank you so much, Larry Summers. He's our special contributor. Of course, he's former Secretary of Treasury. And that does it for the end of a very long week in which equities pushed up despite the concerns about China. That does it for Wall Street Week. I'm David Westin. This is Bloomberg, and we'll see you next week.